So today we are looking at a company valued at roughly $3.6 billion. And to, kind of put that into perspective for you, that is basically the GDP of a small country.
Yeah, it really is a massive number.
Right. But here is the catch, and it's a huge one. This multi-billion-dollar company has never made a single dime in revenue. Like, not one dime. Welcome to our deep dive on QuantumScape.
I have to say, it is probably one of the most fascinating contradictions on the market today. I mean, you have this staggering $3.6 billion valuation on one hand, and then on the other hand, you have financial statements that read way more like a massively funded university science experiment than an actual corporate balance sheet.
Yeah, and that is exactly what we are unpacking today. We're going to break down the underlying science, the rapidly shrinking financial runway, and just the intent market psychology surrounding this ticker right now.
Because QuantumScape represents this high-stakes, incredibly cutthroat race to commercialize what the whole automotive industry considers the absolute holy grail of EV batteries.
The Holy Grail. I love that term for this. Because if they actually pull this off, it fundamentally changes the entire global transportation grid.
It really does. But, as an analyst, you always have to ground that futuristic potential in the current gritty reality.
Yeah.
This is your classic binary outcome play. High risk, incredibly high reward.
Right. It's all or nothing.
Exactly. The underlying science they're developing is undeniably brilliant. I mean, nobody is arguing that. But their financial runway, meaning the actual cash they have sitting there to build the factories and manufacture these batteries at scale, it's shrinking fast.
It's a race against the clock.
Yeah. And the stakes for shareholders literally couldn't be higher.
So before we can even begin to understand why this stock's price chart looks like a terrifying roller coaster ride, you really have to understand the product. The thing that supposedly justifies that $3.6 billion price tag with zero sales.
Right, the technology itself.
Yeah, so QuantumScape is an advanced solid-state battery developer. And their competitive moat, the thing that's keeping all their rivals up at night, is their proprietary intellectual property. Specifically, they've developed this anodeless cell architecture and a flexible ceramic separator.
And to really appreciate why that is such a massive breakthrough, we have to look at the limitations of the batteries you and I are using right now.
Mm-hmm.
The ones currently sitting in your smartphone or, your electric car, traditional lithium-ion batteries.
Okay, let's unpack this. Let's talk about the exact problem they are trying to solve. Because in a traditional lithium-ion battery, you have these liquid electrolytes moving the energy back and forth, right?
Right, it's liquid. And over time, as you charge and discharge that battery over and over, you get these microscopic, spiky lithium formations. They're called dendrites.
Dendrites. That's the key word here for anyone listening. Dendrites.
Yes. Think of dendrites like tiny, sharp, metallic roots growing inside the battery. And eventually, if those spiky formations grow long enough, they literally pierce through the barrier, separating the positive and negative sides of the battery cell.
Oh, wow. And when that happens?
Well, when that happens, you get a short circuit. At best, your battery just dies. At worst, and this is the scary part, because that liquid inside is highly flammable, you get a very dangerous, very hot fire.
Right. So to fix this, you obviously need a completely different kind of barrier. We actually talked about this right before the show, and you had this really great way of visualizing what QuantumScape is doing with their solid ceramic separator.
Yeah, so I like to think of a traditional lithium-ion battery like a multi-lane highway. The energy, which are the cars, can move freely. But because it's a wide-open highway, crashes can happen.
The crashes being those dendrite short circuits.
Exactly. The crashes can easily happen and shut the whole highway down.
Yeah.
But what QuantumScape's ceramic separator does is it acts way more like a high-speed rail system.
Okay, a high-speed rail.
Right. The energy still moves rapidly. In fact, it actually moves much faster.
Yeah.
But it is physically locked onto a track. The ceramic physically blocks those spiky dendrites from growing and crashing into the other side while still letting the lithium ions pass through perfectly.
Which unlocks some incredible theoretical benefits, right? Because you don't have to worry about those short circuits. You can push a much higher energy density.
Massively higher.
Meaning EVs go way further on a single charge, and you get drastically faster charging times at the station. Plus, you get this huge improvement in safety because you've removed the flammable liquid and replaced it with this solid ceramic vault.
Right, it's non-combustible.
And QuantumScape has a multi-year head start in this solid-state R&D, which creates a huge barrier to entry for any new competitors trying to jump in now. But Here's where I have to push back a little bit.
Sure.
If this tech is so vastly superior and they have this massive multi-year head start on everyone else, why aren't these batteries in every single EV on the road today?
Well, what's fascinating here is that there is a brutal, often heartbreaking gap between perfecting a scientific breakthrough in a highly controlled laboratory and actually scaling that breakthrough for commercial mass automotive production.
It's all about the execution.
Exactly, it's execution. In a lab with PhDs in white coats, you can create the absolute perfect ceramic separator. But to put it in millions of cars, you have to manufacture those separators flawlessly, millions of times a day, at a cost that makes basic economic sense.
And ceramic is notoriously difficult to work with, isn't it?
It is incredibly brittle. It is highly prone to microscopic cracking. So yeah, their patents completely protect them from competitors just stealing the design, but the execution risk, the sheer physical mechanical act of building the machines that build the batteries without shattering the ceramic, it's astronomical.
It logically brings us right to the financial reality check. Because the immense difficulty and the crazy cost of moving from a sterile lab to a gritty manufacturing floor, it's immediately obvious when you look at their financial statement.
Oh, definitely.
Looking at their latest Q2 2026 earnings report, it is a tough read for a traditional investor. Their non-GAAP earnings per share, or EPS, was negative 16 cents.
Right. And just to clarify for everyone listening, when we say non-GAAP, we're talking about an adjusted number. It strips out one-time expenses or non-cash items like, stock-based compensation to give you a much clearer picture of their core operational spending.
So that negative 16 cents is essentially what they are losing on their day-to-day operations per share.
Exactly.
But here is what I don't get, and maybe you can help me here. That negative 16 cents actually beat Wall Street's consensus estimates by 13.7%. The analysts guessed they would lose more. So wait, they lost 16 cents a share and the market is supposed to be celebrating.
This sounds totally backward.
How is a negative EPS a good signal just because it was slightly less negative than a guess? So what does this all mean?
It's a really fair question. To answer it, you basically have to change how you evaluate the company entirely. When you are looking at a pre-revenue growth company, traditional metrics completely fly out the window. Like if you look at their sheet, revenue growth is literally listed as NA.
Because they sell nothing.
Right. Gross margin is NA.
Right.
They do not have a commercial product to sell yet.
So what on earth are we actually measuring then?
Cash burn and runway, period.
Yeah.
How much money are they setting on fire every single month to build out their manufacturing lines, what they call QS0 and QS1, and exactly how many months do they have left until the bank account hits absolute zero?
Okay, so it's a survival metric.
Exactly. If we connect this to the bigger picture, when QuantumScape reports a narrower loss, what they're really reporting to Wall Street is that they just bought themselves a little more time. It shows improving operational efficiency and tighter cost management.
Right.
Every single dollar they save buys them another day, another week to perfect the complex machinery in that QS1 line before they run out of capital.
Okay, buying time. That makes total sense. Their free cash flow is deeply negative because they are aggressively pouring every spare dime into R&D in those factory lines. And that actually brings up another really interesting metric from the financial data, their price-to-book ratio, which currently sits at 3.254.
Yeah, and that number is incredibly telling.
How so?
Well, in a normal mature company, a price-to-book or PD ratio helps you understand how the market values the company's tangible assets, its actual factories, its physical inventory, compared to its stock price.
Right.
But for QuantumScape, a PB of roughly 3.25 means the market is essentially assigning almost all of that 3.6 billion valuation solely to their intellectual property, their patents, and whatever cash they happen to have sitting in the bank.
Wow. So they beat earnings by losing a little less money. They are saving cash to extend their runway. But the market's reaction to this bought time has been remarkably harsh. It's created this intense tug of war between the bullish believers who see a transportation revolution and the bearish skeptics who just see a massive burning money pit.
It's a very polarized stock.
Totally. Let's look at the actual price action because it is brutal. We're looking at a stock currently trading at 5.115 cents. That was down nearly 13% just on a day of the report alone. And it's hovering dangerously close to a 52-week low of 5.645 cents, which it hit fairly recently on July 17th, 2026.
And if you zoom out even further to the multi-week returns, it paints an even bleaker picture. The 52-week return is a staggering negative 57.4%. I mean, think about that. More than half of the company's entire market value, totally wiped out in a single year.
That is painful, and it is violently volatile. The market data notes a beta of 2.68. Now, for you listening, beta measures volatility against the broader market. A beta of 1 means the stock moves pretty much exactly in step with the S&P 500.
Right.
So a beta of almost 2.7 means this stock is like a seismograph in an earthquake zone. If the market dips just a little, QuantumScape plunges. If the market rallies, it rockets. It is wildly volatile. And we see that sentiment is totally fractured everywhere. The stock actually fell nearly 4% in after-hours trading, despite that earnings beat we just discussed.
Yeah, that after-hours drop, it really tells you everything you need to know about the psychology of pre-revenue tech investing right now. Investors in this specific space are fiercely impatient.
They want results yesterday.
Exactly. They need constant, significant catalysts, like a massive new OEM partnership or a major, undeniable breakthrough in testing data just to keep the momentum going. When an earnings call essentially just says, hey, we are slightly more efficient but still years away from mass production, the momentum fades. Profit-taking or just plain exhaustion sets in.
And Wall Street analysts are completely divided on what to do with it. On the bullish side, you have Seeking Alpha upgrading the stock to a buy when they compared it to a peer company, Solid Power. Their argument there is that QuantumScape's R&D progress and the quality of their current funding make them the most likely winner in this highly specific niche.
Right, they see them as the best in breed.
But then, on the completely bearish side, you have other analysts downgrading them to a sell. And their reasoning was deeply concerning to read. They cited allegations that PowerCo, which has been a major backer for them, is supposedly cutting funding.
That's a huge rumor.
Yeah. And they also pointed out that a recent deal QuantumScape signed with Honda remains strictly for R&D, not a firm commercial manufacturing commitment.
It is the classic difference between dating and getting married in the corporate world.
I like that analogy.
Yeah, an R&D agreement.
Yeah.
Where an automaker says, sure, we'll test your cells in our lab. That's dating. It's just exploring the potential.
Yeah.
A manufacturing purchase order where they say, we are definitely putting this in our 2028 fleet, and here is the hard cash. That is marriage. The bears are pointing out that QuantumScape hasn't secured the marriage proposal yet.
To make matters worse, they are fighting this massive macroeconomic headwind right now. We're seeing Brent crude oil topping $100 a barrel and bond yields hitting 18-month highs. And I actually want to pause here for a second. Because we hear about bond yields all the time on the financial news. But why exactly do high bond yields and high interest rates crush a pre-revenue battery startup so disproportionately?
It comes down to one thing, the cost of capital.
Okay.
When a company has no revenue and deeply negative cash flow, they survive entirely on borrowed money or by selling new stock. When bond yields and interest rates are really high, borrowing that money suddenly costs an absolute fortune.
Right. The interest payments would be crippling.
Exactly. Furthermore, investors can get a guaranteed, basically risk-free return of, say, 5% just by buying government bonds. So if an investor can get a guaranteed 5% return doing absolutely nothing, their appetite for throwing money at a highly speculative, high-beta battery company drops significantly, unless, of course, the potential payout is astronomical. High interest rates essentially suck all the available oxygen out of the room for speculative tech stocks.
Okay, that makes perfect sense. So they are fighting expensive capital, they beat earnings, they are saving some cash, yet the stock tanked to near $5 levels. Here's where it gets really interesting. Is this massive drop purely a macro-level panic because oil and interest rates are high, or is Wall Street genuinely just losing its patience with these constant commercialization delays?
It's definitely a combination of both, but this raises an important question, maybe the most critical concept for anyone looking at this stock to understand, which is dilution risk.
Dilution risk.
Right. The primary bear case isn't just that the ceramic separator tech will eventually fail to scale. I mean, that's a worry. But the real immediate fear is the math of survival. If QuantumScape continues to burn cash and runs out of money before that QS1 line is fully producing commercial batteries, they will be forced to raise more capital just to keep the lights on.
Right, they have to go back to the well.
Exactly, they have to go back to the well. And let's walk through that math conceptually. If they have to issue new shares of stock when their price is depressed, all the way down near $5, they have to issue a massive, staggering mountain of new shares just to raise a decent amount of cash.
Because the shares are so cheap.
Exactly. And if you issue millions of new shares, you heavily dilute the value, the ownership percentage, of every single share currently held by existing investors. It creates this vicious downward cycle. The lower the stock price goes, the more dilutive and punishing a future capital raise becomes.
A death spiral.
Yes, I'm calling it a death spiral. And that fear of a highly dilutive lifeline is exactly what Wall Street is pricing in right now.
That is a terrifying prospect for a current shareholder. So when the Wall Street analysts are completely divided and these macro forces are just wreaking havoc, I always like to look at what the people inside the building are doing. What are the executives and insiders doing with their own personal money?
It's always a good indicator.
Right. And the data over the last 90 days shows 15 insider buys and 28 insider sells. That resulted in a net sale of over 1.07 million shares. As a listener trying to make sense of this, seeing the executives inside the company dump over 1 million shares feels like a giant flashing red flag. I mean, are they running for the lifeboats?
It was a very natural reaction to see 1 million shares sold and instantly assume the worst. But this requires some vital nuance, especially in the tech sector.
Okay, talk me off the ledge here.
In pre-revenue companies, executives are often compensated heavily in stock rather than massive cash salaries. When those stock options finally vest, meaning the executives are finally legally allowed to sell them, they frequently do so automatically just to cover the massive tax bills on that compensation. Or, just to diversify their own personal portfolios a bit.
I see.
Yeah. Massive insider selling in this specific context is often programmatic. It is scheduled months or years in advance and happens entirely regardless of the company's immediate outlook or recent earnings.
Okay. So it's not necessarily the lead engineer looking at the lab results, panicking, and selling everything on their phone. It's just their scheduled payday and the IRS taking its cut.
Precisely. What is actually much more analytically significant in that data is the 15 buys.
Really? The smaller number.
Yes, because executives almost never buy stock on the open market with their own hard-earned after-tax cash unless they genuinely believe the company is currently undervalued. The fact that there are 15 distinct buying events indicates that at least some insiders actively believe this near $5 price level is a depressed contrarian bargain.
That is a huge distinction to make. And it seems those insiders might be looking ahead to some potential catalysts on the horizon, too. We're seeing some speculative whispers, totally unconfirmed, obviously, but definitely moving the rumor mill right now. There's chatter about potential breakthroughs and throughput yields on that critical QS1 manufacturing line.
And throughput yield is a vital metric here.
What does that mean exactly?
It refers to the percentage of batteries that come off the assembly line actually usable versus the percentage that are defective and just have to be thrown straight in the trash.
Oh, wow. Okay.
If you are manufacturing brittle ceramics, your early throughput yields are usually terrible. You break a lot of stuff. A high throughput yield means you've finally figured out how to build the machine that builds the battery efficiently without breaking it.
So if the rumors are true that they're improving those yields, that directly addresses the exact scaling problem we discussed earlier. And it potentially accelerates their timeline for automotive qualification.
Absolutely.
And beyond the manufacturing rumors, there is also speculative interest regarding new OEM partnerships. Basically, new automakers signing on beyond the existing agreements. If they transition from an R&D dating phase to a formal joint venture marriage or, secure, firm, non-dilutive funding, that fundamentally changes the entire risk profile of the company overnight.
It would be massive. Looking at the actual calendar for the next 3 months, investors are going to be laser focused on the Q3 2026 earnings. And to be clear, nobody is going to care about revenue yet. We know that's zero.
Right.
What they will aggressively demand are updates on self-testing data, energy retention metrics, and exactly how much capital expenditure runway is left in the bank. They're also waiting on updates for the commissioning of the QS1 pre-pilot line.
Plus, there's always the macro hope, right? If the Federal Reserve pivots and starts cutting interest rates, it could bring risk appetite back to the broader market. And that disproportionately benefits these high beta, long duration assets like QuantumScape. It makes borrowing cheaper and survival much easier.
The calendar is packed with make or break moments. Every single data drop from that QS1 line is going to be heavily scrutinized for absolute proof that they can actually build these things at a speed and cost that the automotive industry demands.
So bringing all these threads together for you listening, the final investment thesis drawn from all this data gives QuantumScape a bullish score of 6 out of 10. They frame it as the ultimate multi-year hold. It requires immense, perhaps agonizing patience to weather this kind of extreme volatility and macro pressure.
It really does.
The upside is undeniable. If they scale the QS1 line, keep improving those throughput yields, and secure funding that doesn't dilute the stock to oblivion, The potential from these depressed levels is massive. I mean, they could literally power the next generation of global transport. But the downside is equally clear. If they hit more delays, the capital burn rate will sink them before they ever reach the finish line.
It is the ultimate tightrope walk, and I think it leaves us with a really profound question about how innovation actually happens in the modern economy. We always celebrate the eureka moment in the lab,
Hmm.
the brilliant scientist discovering the anode-less architecture. But if solid-state batteries are undeniably the future of the entire global transportation grid, how much of ultimate success is really about inventing the absolute best technology versus just being the company that can survive the financial bloodbath long enough to actually manufacture it?
That is a phenomenal question to ponder. Is the ultimate winner the best scientist or just the best financial survivor? Well, thank you for joining us on this deep dive today. We hope this helped clear the muddy waters around QuantumScape and the wild, high-stakes frontier of solid-state batteries. Keep exploring, keep questioning, and we'll catch you on the next deep dive.